Welcome everyone. Good morning. Let's start our lesson 3. Today lesson will go through LO3 as you know. Please, if you have any question, drop the email at ukversity.co.uk and I'll try my best to get back to you as soon as possible. So today lesson we'll do a bit recap first what we learned during our previous lesson and then we'll start our lesson. Okay, so we are doing LO3, learning outcome 3, which is be able to evaluate the proposal for strategic decisions on capital expenditure. So when there are two types of expenditures, one is called capital and second is called revenue. So when we'll say capital expenditure, it means we are buying the non-current asset. The non-current asset means the asset which we can use number of years. Such as building, plant, machinery. So any money you spend to buy it, acquired it, it will be known as a capital expenditure. If you're spending any money to maintain it in the same condition, like a cleaning, painting, coloring, decorating, these will be known as revenue expenditures. These are the part of income statement, I would call profit and loss, and the capital expenditures part of balance sheet. So today, we have the command verb, always good to be look around, evaluate, interpret, assess, and review. We have, these assessment criteria which we'll go through. When we say evaluate, it means qualitative judgment, taking into account of different factors. If you're doing different factors, you're evaluating. Interpreting, translate information into the recognizable form. You can interpret like a ratios and others according to the environment. Assess, the reason, judgment, or standard, or quality, or situation, or skill. Review the survey information, methods, and outcome. These are we call reviews. So these are the command verbs. Today lesson indicative content, which will go through different investment appraisal. We look around different expenditures, what is meant by how we can manage them, and internal, external, with their advantages and disadvantages. That will be in our lesson. So if we'll do a bit recap what we learned during our previous lesson, we discussed about financial ratios. Okay. Financial ratios. So we had a discussion. Ratios, the relationship between two numbers. Financial ratios help to measure the performance. So we had a discussion on profitability. We discussed about liquidity. We discuss about use of resources, or we call efficiency ratio, and we discuss about gearing ratio. So these are key ratios we learn about. Then we discuss about financial statements. We discuss how many types of financial statements we prepare in account. We discuss about management and financial accounts. We discuss about qualitative, quantitative characteristic about financial statements. And we had a discussion about budget, budgetary control, variance. We had a discussion about variance as well. And these were the key points we discussed in the previous lesson. Purpose of accounting, function of accounting. We discussed about data, information, and knowledge, and we discuss about financial and non-financial information, like we discuss about CSR reports and various other things. Okay, so that was the key which we discussed in the previous lesson. We'll start today's lesson. Today we are looking 3.1, review the method of appraising. When we say appraisal, like in an organization, you have appraisal. So always appraise and check the performance. Appraisal means checking the performance or measured. So we can, if you're investing heavy money or high money or capital expenditures and investment, so always look around what will be the return. How long will it take to return? What sort of the risk involved? What is the opportunity cost? What is the purpose of the investment? Why are you doing it? What benefit will bring? So these sort of question you will ask, so those I included, please, always performance when you measure in time, in cost, and quality, not just focus. So I'll always ask, why you're not using Nokia? Because the Nokia, they focus mostly on financial, the cost, they cut the cost, they close many R&D, research and development centers. So ultimately the company not sustain. So for the sustainability point of view, it's a crucial. We look around and we sustain in the business, and we can only sustain in a business if we um, focus on three areas. Yes, quality as well, not the long-term benefit of research and development. So the capital investment or capital expenditures will go through different appraisals. We'll discuss about the payback period, return on capital employed. We'll discuss about NPV and payback period, investment appraisal techniques. That we'll discuss. Okay, if you any point if you're not get, please you carry on asking. Okay, so investment appraisal is a business concept which is consists of the future income is derived from the investment. Really, we want to make sure the investment how much will be and what sort of value will be. If we are getting £10 after 2 3 years, if the inflation is 30%, so after 2 3 years, it means the return will be zero in real world, because the value of the money is dropped with the passage of time. So we have to look around the real value of money as well. So payback period mean how much you invest, how long will takes you the money you invest and get back. This is easy. You invest £100, if you're getting £50 each years back, so in 2 years you will cover your £100. So that is mean payback period is a 2 years. So so we compare, if you have various options, you're looking the payback period. So it's a easy to calculate, easy to understand, and consider timing of the cash flow. But what is the disadvantage is the short-term thinking, does not consider the profitability, is ignored the revenue and the cost occur and the payback is achieved. They only focus on not the, maybe the some project have the profit forever. So let's look example. When we look at example, that will be clear. So we investing £3,100. We are getting in year one, 1,000, year two, 900, year three, 800, year four, 5, and 5. So if we add it 1,900, 800, 2,700 plus 500, that makes 3,200. So we can say this project will take 3 years plus some month that will cover our £3,100. So if we look here in the cumulative column, the cumulative mean total. So we invested 31, we cover 1,021 is left. We 1,200, 21 minus 9 is 12 left to cover. 12 is outstanding. 8 we are getting. 4 is outstanding in year 3. At the end of year 3, 4 is outstanding, which we supposed to be. But year 4 we are getting 5, which is higher than 4. So we can say outstanding amount divided by the following year inflow, which is mean money coming in the business, times by 12. You can find it how many months will take you to cover the £400 when you're getting £500 in a whole year. So we can say this project will take 3 years and 10 months. Yes, 3 years and 10 months will this project will take. Outstanding amount divided by following year inflow times by 12, 12 months in a year, and we can say this project will take 3 years and 10 months. Any question? If you have, please you can ask. Okay. Next, we're looking the payback investment appraisal method is called discounted cash flow, or NPV. It's the net present value. Just a simple rule, because the value of money is drop, it depreciate. We're not looking in terms of the foreign currency, but the money you have today is more worth it the money you will get in future, because it's reduced its value. That's why we really want to make sure the money we have, we invest in these projects, it's not lose its value. So we have to look around NPV, which is called net present value. Morning asset. So we can look around NPV, the net present value. If NPV, your result come positive, you accept the project. If NPV come negative, you reject the project. So you say, I'm not going to invest in that project. So NPV is called net present value, is quite good, which we looking the real value of money, consider the time value of money, take in account both timing and the amount of the cash flow is based on the cash flow. But it's all is the estimate, it can be difficult to calculate, and sometimes is all discount rate and use is arbitrary, it's not really which we can look at. Let's look, the example here. In this case, we are investing £2,000 in year not mean year zero. Uh, Today date is the current year. We are investing 2,000. We are getting in a year one 5,000, year two 7,000, in year three 8,000. So that makes really the £20,000 in 3 years. So if we look the payback period as we discussed earlier, so payback period of this project is 20,000. 20 you investing, 20 you getting. That's your payback period. What you invest, you will get. After that, if you get anything, you will earn the profit. Okay, so what will be the real value of that 20? So we look NPV table, which is called your PV table, we call present value table. So we'll say formula is 1 plus R, 1 divided by 1 plus R. So R is the discount factor. If we say, let's say inflation is 6%, 6% is the base rate, 3% is the inflation, and of course, we looking other expenditures. You want more than 10% return, so you can depreciate your currency, discount it at 10% to calculate. So what you do, if you do one, what is meant by 10%? Is I can write it 0.1. So I can say 1 divided by 1.1. So your answers will come 0.909. Then you do whatever answers will come, carry on dividing by 1.1. You will get in year 2 8.26. Whatever your answer, carry on dividing 1.1, you will get 0.751. Because it's mean the £1 in year naught is £1, but after 1 year is around 90 pence, after 2 years is 82 pence, after 3 years is 75 pence value of the pound. Any question here? If you getting 5,000 times by 0.909, so you can say actually in your hand is a 5,000, but the value of 5,000 is a 4,545.
How much is the, sorry to cut you, Anwar, how much is the percentage again? The depreciation percent, 6%?
No, just I'm giving you estimation if you need to.
Mm-hmm.
We have in the UK base, assume at the moment base rate is a 5%. Yes.
Mm-hmm.
So we have an inflation 3%. So 5 plus 3 is 8%. And maybe you have some expenditures, you want at least 2% your return on investment. Yes, minimum. Because if you save money into the bank will give you maybe 8% interest rate. Yes. But if you investing in project, you taking the risk, you want more return. So I'm saying you can estimate, you want discount factor 10%, you depreciating the value of money to see what is the real value which you're getting. So if you're investing 20,000 and you're getting 20,000 in 3 years, but that actually you're not at the break even, because the reason the £1 today is a £1, but after 1 year, so I'm using one. This is called PV table. You can find in any accounting book, management book. You can say 1 divided by 1 plus R. You can use the formula to calculate. 1 is in formula. 1 means today is a £1 is a £1. This 1 is in formula, and R is the discount factor. So if I'll say 10% in mathematically, I can write it 0.1. If I'll say 15, I can say 0.15. I can say 0.2, which is 20%. So I can say 1 divided by 1.1 because it's a 10%. So if you do 1 divided by 1.1, what your answers will come on the calculator if you do?
1 divided by 1.1. Here you have 0.909, right?
Yes. So then whatever answer 0.909, you divide on 1.1 again.
Then you will have 0.826.
Yes. So that carry on coming. So if I'm getting 5,000 pounds, because the year not your investment, the cash outflow, the money went out from the business 20,000. So you multiply because the £1 is a £1 today date and is a 20,000 pound is the outflow. Then you're getting 5,000 end of year one, 5,000 times our discount factor. Actually, 5,000 real value is 4,545 pounds. The things 1 year before you can get 5,000 pound worth of the good. Today you can get it 4,545 pound because the value of money is dropped. So if you're giving a lending to family friends, of course, morally is correct, but in a financial world, you're losing the money. Even you're getting the same money back. Of course, God give you reward or other religious prospect. That's a separate thing. But we can look around in the business perspective. Yes, today business. Yes, that's which we can look around 4,545. If you're getting 7,000 pounds in year two, and actually 7,000 value is 5,782 pounds. If 10% depreciate. 8,000, if I add all my positive figures minus my negative, so my positive figures are less than my outflow, so I reject this project. I'm not going to invest it because it's not make 20,000. Real value is less than. So NPV is a negative, we reject the project. If NPV is a positive, we accept. NPV means net present value. You got me?
Yeah, can you show the slide down? There's a little bit down. Think there's you calculate the NPV down or?
So we calculated here. Just you add them all.
Yeah, no. This is the present value. I'm saying NPV, have you calculated down or?
No, I'm just I'm just showing you here. Okay. We have a couple of other questions where we calculate.
Okay.
So if you add them 4,545,
Yeah,
572, 6,008, yes. Then you minus your 20,000. You minus your answer is a negative. You want me to show you?
no. Okay, it's obvious. It's obvious.
Okay.
4,500, 5,700, and 6,000. It's like 16,000
Yes,
pounds. So you invested 20,000. You're losing.
you're losing. So you're negative NPV. Yes. Net present value you have negative. Then we have a other investment appraisal method, which is called ARR. It's called average rate of return or average profit. So the formula is we use, we can get it average. Average profit divided by initial investment times by 100. If we compare one project with other project, whichever project is a higher ARR, you accept the project. Yes, you have option A, option B, option C. You're going option A, then you can look around what is the return per option. Let's go look, this example make more sense. We have three projects, Handover, Bristol, and Carlisle. All required investment, where A and B required 4 million, 4 million. But if you go for the project C, if you take, that's required 5 million pound worth of investment. Okay, so now if you each year you have a return of or your saving or your profit or whatever you get return, so 1 million, 1 million, 1 million, 1 million, and the project lasts 5 years. So in 5 years you getting 5 million, but you invested 4 million, 1 million you have a profit. Yeah. So but that 1 million came in how many years? 5 years. So what is your average profit a year? Is 0.2 million. Yes, 0.2 million. So if we look other project B, We get year one 1.5, 2.5, 0.5, 0.5. So you're getting exactly 5 million minus 4. You have 1 million profit divided by 5. So your average profit is 0.6. So if I'll say you have two options to invest, which project you will go ahead? A or B? If you have two options to invest. Without looking at the moment the percentage. Which one? Both have average profit 0.2 point. You think you will go for A or you will go for B? What do you think, Asad?
I will go for B
Okay, why for B?
because I'm getting higher cash flows in year 1, 2, 1 and 2, and then so they get the present value of these is higher in year 1 and 2.
Well done. That's the logic. Okay, if we look the project C, year one you're not getting anything. Year two you're getting 0.5, 1.5, 2 million, 3 million, and we getting total profit is 2 million. Because 7 million minus 5 million is equal to 2 million. So you're getting profit 2 million, which is coming in 5 years divided by 5. Each year you're getting 0.4 million profit. So if I'll compare A, B, I'll go for project C, the better than A, B. But the problem in C, if you don't have a 5 million, so what you will do, then of course you will go for. Okay, so in that case, if I look the percentage, you can do average profit divided by. So here is the 5%, 5%, and 8%. How this came? Average profit divided by initial capital investment, which is 4 million, time by 100. So that's the 5% return, 5% return. And is Carlyle is 8%. If the bank give you 5% interest rate, you deposit the money. What's the point to take a risk to invest in Handover and Bristol project? So I can deposit money into bank. It's fine, yeah. So because here we getting, if you're getting more than are in the long run, you have multiplication effect, then of course you go up project. Any question?
No, it's okay.
Okay, so then we have other projects which we can look around A and B. Here we can calculate the payback period. So we can say 10,000 you're investing 3.5, 3.5. That makes 7, 3.5. That makes 9.5. And it means this project will take 3 years and some months. And this project will take 6 plus 4 is 2 years. So we can say project B is better than project A. And the basis of this is exactly the same. If you want to calculate the NPV, we can calculate, and you can calculate for these. You can compare ARR for these projects as well, exactly the same. And you can do more activities. So 100,000 you invest, 60, you will get, you're getting 120, 100. So this project will take 1 year and few months. Yes, and other project will take the 5 years. So you can look around 5, 7. This project will take 1 year and few months, and this project will take 5 plus 6. And this project will take more than 500 to 50, 200. This project will take 4 years and few months. So we can look around on the basis of payback. We can do ARR, and then we can decide which project you want. So you can look around. So all these investment appraisal methods quite good to be look around, and we want to be budget our capital expenditures accordingly. So what is the budget? Budget is a financial plan for future. So we can look around what is the budget. Budget is a financial plan for future where we can budget. We need to be get the information. If you don't have the, always look around the purpose. Budget is the budgetary control. Always look the variance, look the performance, and then you invest in the project which you want to be selected. Okay, next we have 3.2 is evaluate the business proposal of capital expenditure. So you have to appraise first, look around which one is the best, and then look around the sources of finance, where the money will come from. You do the leasing, you do the equity. Debt is better than equity. Debt is cheaper than equity, because if you equity mean the shares are the investment, but the shareholders expect return more than, let's say, 10%. And the equity when you get the debt from the bank, maybe bank give you 6% interest rate, and any interest you paid on the money you borrow is expense for the business. So it's good you have a debt instead of equity. But if you have too much debt, you can't afford it to pay the back the money, your company can become liquidate. So that's we need to be look around. We can think about the strategy. Strategy mean action plan. We can look around the objective. Any strategy you will make, we can look around the factor, where the money will come from. And you need to be control. Control is a corrective action. So budget function is a planning, coordination, and control. Budget help you to be really function organization. We can do centralized is a quite good program. Undercover boss, to watch, because when boss is sitting in office make budget but don't know the ground reality what is. So always good to be understand the ground reality. So then you make the budget, and then the budget can be more appropriate. So that can we look around. Then when we look at the classification of the budget according to the time, we can look around short term, long term, medium, current, rolling, sale budget. So any budget you want to make, first thing is the sale forecast. If you're expecting sale will go up, you need more production, you need more purchase, you need more personnel, you need more capital machinery plant. So you can look around the budget. According to the flexibility, it can be fixed budget, flex budget. So these are different techniques. So budget is a financial plan, and capital expenditure budget, which is mean the money which you want to be spent on the replace of asset, buying asset. Cash budget is the most important, because the cash is the lifeblood for business. You have to look around. So this is one of the example we included. We have, so anything we budget we making, we have July, September, October, November. The sales we have, purchase we have, wages we have to pay, and that. Then we have a cash balance at the beginning of October. We look the 50% debtors, which is mean the credit sales we have to our customer. The 50% money we receive end of the first month, the month we sell, and the 50% they will pay me end of the 2 months. So that's and we can, when we purchase from our suppliers, 50% purchase, one supplier will can get the 10% discount and pay in the same month, and the remainder 50% will pay in the following month. The new equipment costing us, which will pay, and the wages will pay in 1 week arrears, and we can calculate these, and we can see what is the cash position in each month. And if we have a cash less, we have to make arrangement. So you will see there we looking the opening balances at the beginning of, and then we calculate all each budget. So purchases and all, let's we look, so we have calculated. So if we have a sale in July, so 50% you will receive in July, 50 you will receive in August 50 you will receive in August and September, and so on. We have making the budget for these 3 months, October, November, December, but that link with the previous month, because the cash will carry forward. Okay, so if we look the payment side, so in July, will purchase 50% off is a 12.5, because 10% will discount 90% of 12.5 will pay. So it means we'll pay 11,240 in that, and remaining 12.5 will pay in again. So we'll carry on doing these way, and we can look around October outgoing, money in purchases, October incoming, November and December, and then we transfer all these figures into our template which we calculated. So we can say in our opening balance, we have receipt we will get in October. That's total money in October and November and December. So we can look around there how much money will be outgoing as a payment. So we have wages, we have salaries, we have sundry expense. So that's outgoing, that's incoming. The difference is my closing balance. So this month closing, it will be next month opening. Yes. So that's, you carry on doing. So we can make the budget this way. And we can see in these 2 months, in November and December, we have a negative balance. So really we can struggle. We have to make arrangement because otherwise we'll be out of the cash. Yes, so maybe we arrange our draft with the bank, or we chase to customer to get, or we'll focus on the credit management to give less credit or promoting more cash sale. So that's the way we can look around. Any question if you have, please you can ask. Okay, so when you're making the budget, are you looking the money, borrowing money? So next we're looking the sources of finance, where we can borrow the money if we need to. Always when you decide where you borrow, look the cost, look the debt, uh, duration, look the term of the interest, look the gearing ratio, debt to equity, how much debt you have in a business, how much equity you have, accessibility. Then always look as well. Then you can decide, which one you go. Okay, internal sources of finance. If we have a retained profit, if we have sale of stock, sale of fixed asset, that we can raise money through these. Bank loan, additional partners in the partnership business, share issue, leasing, hire purchase, mortgage, trade creditors, which we can. External sources of finance, loans, which we can. Bank overdraft loan can be long term. Any interest paid on the loan, it can be uh, cost, and we can claim as expenditures from, and we don't have to pay. The tax bill can be lower. That's why we look, more debt. Sources of finance, shares, of course, shares mean any registered capital in the company house, we can issue the shares to the public. Business angel, rich people, they can borrow money, but they'll charge the interest. So we can look around what control they want. Then we have a merit criteria. Assess the importance of the cash flow. Cash flow is the lifeblood for any business. We need to be really manage the cash. The one of the management objective to be treasury management, manage the cash and look at the current asset, short-term investment, working capital, finance, and dividend. Dividend, how much we'll pay, and how much money is coming. And of course, if we don't pay the dividend, the shareholders will be demotivated. They will not going to stay with us. So we can look around investment decision. Any investment decision, we're looking the purpose and the cost and the benefit short term. So we do the appraisal, net NPV, ARR, and the payback period. There are other investment appraisals, but these are according to our syllabus. We look financial consideration on surveys, which we can look around the government impact, the taxes, risk. Risk is the probability and the chance of happening. Always we keep, in mind before we making the decision. Thus we need to be look around. Then we've been given a lot of, like NHS project, National Health Services, or any other project, you look around the sources of finance, but you'll always look around. Okay, when you look the objective, SMART objective. SMART is means specific, measurable, achievable, relevant, and time bound. If we want improve performance, improve profit before tax, measure improve profit before tax and improve profit before tax by 20%. Achievable, which we can improve profit before tax by 20, improve profit before tax by 5. Relevant, improve profit before tax and reduce the debt. So in the time bound, and reduce the debt by 15% and reduce the debt by 15% in 18 months. So with these are some, example of SMART objective, not like, lover always saying that brings star for you, but never got. So these, we need to be make sure we'll carry on doing strategic analysis, we'll carry on looking the mission, looking the value, do appraisal, and then you can decide which project. So here is NHS, project is, we can look around the growth rate, we can look around next 5 years equivalent, how much will be, greater anticipated inflation. Of course, you need the money for it. Otherwise, waiting time, your benchmark, your commitment can't be achieved. And always we need to be look around. If the number of users increase, you have to think about. So these are some examples of the budget of NHS. So real change in pension adjustment, we have a national minimum wage adjustment, noise increase. So in different areas, the budget differentiation. So that's, and we have an article on budget and investment appraisal. So please go to read, enhance your understanding about investment appraisal. And then we have the case study. If you copy that, you can read. We have a PG group. So that's, which you can for that case study. Managing the store relocation, we've been given on our Moodle page is the Marks and Spencer reallocation, the project that they're moving the store, and that's also project mean any task, any activities spent your house is a project. Yes, and at the end you've been given the quiz to play if you, and you can do in your time, and all the resources extra. Please, if you click these links where these slides came from, and the resources is good to read further to enhance your understanding. Any question?
No,
Hello.
Alhamdulillah.
Okay, great. So today we discuss about NPV. When NPV is a positive, you accept the project. NPV negative is reject the project. Payback period shorter is a better. Yes, you go ahead with the project which is a shorter. ARR higher is the better. Any project average rate of return give you higher as a percentage, you go that project. So in this way we can manage, and that's the way we can do appraisal of the project. So thanks for attending today's lesson, and we discuss sources of finance. Debt is a better than equity because the debt is a cheaper. Any interest you paid on the debt, it can be claimed against the tax because the debt interest is expense for the business, and you can reduce the bill of the tax. So that is the double effect can be. And now next lesson we'll go through our assignment discussion where we can go back and link all our lessons and embed in our assignment, and we'll go through according to the scenario. So thanks for attending, and next lesson will be about assignment discussion, which we'll do tomorrow. Thank you. Have a lovely week.
Thank you.
Thank you. Bye-bye.
Bye.
Thank you.